Hey, I'm very excited to say that I just completed my interview with Robert Bugbee, the CEO of Scorpio Tankers. The interview went fantastic. I will play it very soon. I know that some of you have submitted questions because I asked you to submit questions, and there was no way that all the questions could have been answered. It was just too many of them, and but what I tried to do is structure the interview in a way so that it answers a lot of the questions. Now, I think it would be a great idea if some of you, because some of you have so much knowledge, look at these questions and try to answer them in the comments below. So I compiled the list that you all submitted to me, and I posted it on my website. The link is in the description. Go there. Take a question. If you know how to answer it, just cut and paste it, or copy and paste it and put it in the comment and answer it. And let's have a discussion. And we can all learn something from it, because the idea behind this video is to educate. Educate the public about the sector. Now, when it comes to the education, I wanted to make you aware of two books that I think you would be benefit from. One is that I recently wrote is How to Profit from the Coronavirus Recession. It has 50 investment ideas, and oil tankers are included in it. The second book that I want you to be aware of that I wrote is Gold Production from Beginning to End. A lot of you are interested in gold miners, but too many times I hear, oh, gold is going up, therefore buy gold miners. You have no idea what you're getting yourself into when it comes to the gold miners. They are terrible businesses. However, when you time them right and you get the right ones, it could be very explosive. That's why I wrote this book. The book is about how gold is produced from A to Z. So, think about it. If you want to invest in gold mining stocks, you should know the difference between open pit, underground, oxide versus sulfide. All probable versus inferred and measured. If you don't know these things, you shouldn't be even touching gold mining stocks. So anyway, I don't want to waste any of your time. Subscribe to my channel so you can get notified about more interviews like this, and let's hear what Robert has to say.
Welcome to Classic Value Investors. My name is Mariusz Konieczny, and I'm very excited today to have with me Robert Bugbee, the CEO of Scorpio Tankers. Robert, thank you very much for joining me.
Thank you. Thank you very much. It's great to be on.
Yeah, so Robert, over the last 6 weeks, we've seen an incredible volatility in the oil tankers, both on the crude side and on the product side. We went from people being super excited to not wanting to touch them. And you've been in this business since the 80s, I believe. You've been on the product side, on the crude side, on the dry side. The amount of experience that you have in the industry is pretty incredible. So can you tell my audience, what is going on in the sector? What is it that the market is missing? Let's just start with that, because the goal of this podcast is to educate and bring people knowledge. So go ahead.
Sure. Well, what I can say is going on is that the product tanker market, which is what Scorpio Tankers is focused on, and the product tanker market is ships that carry clean petroleum products such as gasoline, jet fuel, naphtha, etc., then this market was on a pretty neutral or a bear market for about 7, 8, 9 years post 2009, and then last year really started to change with the regulations related to environment and an aging fleet, plus very little new buildings, into a bull market. And then suddenly we have COVID-19 in the beginning of this year, February. the market itself, the physical market, actually went up and is much, much stronger than what analysts thought it would be during that period. I think this is one of the great ironies. I think that when the stock was 35, 38, most analysts would have had this year earnings in MRs, which are medium-sized tankers, at around 20, and LR2s somewhere around 27, 28. The market has, and you can see in our first quarter results, our guidance for second quarter being much, much stronger. This is partly a result of supply and demand getting tighter under the basic position, but also with this COVID-19, the customers have been looking to do two things. They've been looking to store products on some of the bigger petroleum product vessels, but also for logistical reasons, that many of the ports around the world, the smaller ports around the world, don't have many storage facilities, and there's been a lot of congestion, which has shrunk supply, et cetera. Now, I think what we're concerned about in the company is the longer term here, because what's happening in the industry is that overall, setting aside COVID-19, the ratio of products carried by sea to crude is increasing. Therefore, it's more beneficial in the future to own products than crude. And we at the same time see that the fleet supply itself is either going to be negative or almost flat. Nothing's on order, and simply a product tanker, unlike a crude or a dry bulk carrier, is best if it's under 15 years old. And a number of vessels of older fleets, some of our competitors' fleets are already 10, 11, 12 years old. So the supply looks good going forward. In between, we're going to have a lot of volatility. Most of the bears it's as if the stock price is tied to an inverse relation to crude oil price and the world's economic recovery for COVID-19. That is what's happening in the present stock price, and the present stock price seems to be dislocated from fundamentals. It's fundamentals, however, what we have to run the company on. And we see that because of the factors we pointed out before, we actually believe a super cycle is on the way in the product market as soon as the world really starts to properly recover from this COVID-19. On the way, there might well be a little bit of volatility in earnings. People are worried at the moment and have seen rates come down over the last 2.5, 3 weeks. But I think there has to be some form of relativity, some form of awareness and reality here, that rates have come down to levels that are still extremely high. The levels this morning are higher than almost any day in the last 9 to 10 years. And this is going to provide companies like Scorpio the adequate reserves to be more than able to get through the next few months, whatever the volatility.
Yeah, I think the concern is exactly how you said. Yes, people understand that the rates are high. They understand that the companies are making good money, but they're just so petrified of the unwind and how it can happen. And I don't think anyone has a crystal ball. But
well,
with that in mind, how do you think this might unwind in your opinion?
Look, if I can understand the fear. Okay, I can understand the relationship. They see rates go to extraordinary highs, and then they think, as a result of COVID-19, so they think, well, the world's opening up again, so it will completely fall apart. But there are a couple of things that is going on. First of all, the companies and the company is earning cash. It's real. It's not fantasy. The company is keeping that cash. It's not throwing it. It's not throwing it back onto the streets. So the company each day is getting stronger. The second thing is that the bear argument isn't really based in the fundamental part. It's based in price as opposed to value. And what it's saying is the forward price is backwardated, price will fall, therefore the companies are in trouble. However, at this particular point, there isn't first of all, companies are booking revenue into the third quarter through time charters, forward revenue. Secondly, their balance sheets at present are getting stronger. But most importantly, the actual rate that's being forecast isn't really a disaster anyway. The worst of analysts are saying that the rates will still be substantially above cash and interest break-evens. So even in the worst month of the worst analyst forecast, they're expecting product tanker rates to provide some return, some value to shareholders, whilst at the same time, the actual fleets themselves are trading at a very, very substantial discount to the intrinsic value of the company.
Right.
So that's the answer I would give.
Okay, considering the fact that the cash flows for these companies are volatile, that the rates go up and down very fast, so it's hard to look at cash flow itself and say I'm going to value this on 6 or 10 times cash flow. So how does an investor look at companies like this and get comfort with valuing them?
That's a great question. I think that one can look previously. So just 4 or 5 months ago, company Scorpio Tankers was trading quite solidly around $37, $38, $39. In fact, it did a very significant transaction with one of the largest traders in the world, using its stock at $29 or so. Now, the market then was valuing the company at the net asset value of the company, the actual breakup. Both those values were based off the breakup of the company at that time. And we were buying assets as well as Trafigura were selling assets, and we were using partly our stock. So simply what happened was both parties, very knowledgeable, happily agreed to a net asset value calculation. We gave them stock at our net asset value for their vessels at obviously asset value, and that was back in October at around $29. The market then valued the company, as I said, up to $37, $38, $39 based on, one, the cash that it had made between October and then booked through to February, because we do forward bookings, and some kind of appreciation beyond net asset value because they expected values to increase. So one way you could look at it now would be to say, okay, in 2 years' time, if the world recovers without much on order, with yard capacity shrinking, et cetera, what is it reasonable for a fleet to be worth? And will the company make positive or negative cash between now and then? And that's one way of doing it, which is to create a forward net asset value position. That's a possibly, let's say, an acid test, and is the simplest way to decide how safe or not you are. That would be the way I would measure other companies in the space, in other, even not just in products, but across other areas, dry bulk, etc., to decide whether or not I was buying a stock that was fundamentally discounted to the forward value or not. And
okay.
That would be how I would do it.
Okay, so from what you're saying, you had a transaction that you did when you were priced at net asset value.
Yeah.
Now this question is not necessarily for Scorpio, but would it make sense in this market to have a company trading at, let's say, 75% of net asset value, and maybe acquire a competitor that is trading at maybe 50 times net asset value.
Of 50% of net asset value.
Right.
Yes, yes, that would, that would make sense. But if the two parties were valuing it on that basis, so if the acquiring was able to use its stock at 70% and acquire something else at 50, then that would arguably be to the benefit that would benefit both parties. The company that had got acquired would logically get a kick up in the stock that they bought, because the acquiring company's stock should move up as it's managed to buy something at a discount to net asset value, assuming that that makes the assumption that your leverage is the same, for example, and the quality of assets that the acquiring company is making is the same or better.
Okay. I remember listening to some of your not interviews. You were part of several shipping conferences, and I listened to a lot of them. And I remember one time someone asked you a question, what keeps you up at night? And you said that the difference between the stock price and net asset value is what you were concerned about, or you were thinking about how you can close the gap. Uh, at this point, are you thinking about that? And if so, are there any tools that you might have at your disposal to close such a gap?
It's not really keeping me right now. It's not keeping me up at night, because I think that there's a there's a solid reason as to, I can pretty well see the reasons at the moment as to why the spread is there. I don't think it's to do with the fundamental anything wrong in the future fundamentals. I think you've got a present fear that's there, that and this sort of simplified correlation of oil price to stock price, or gosh, it's a day where we get good news on the world economy, or the COVID-19, and so Scorpio tankers must trade down, which by itself is very irrational. I mean, there's nothing that I would want more than the world economy the people to be healthy, and the world economy to start recovering and being healthy, because the quicker that happens, the quicker we can move to the real fundamentals and the real expansion of value of the company, because we will gain a lot more in a world where the demand for shipping grows against the fundamentals, and it's not some very, very technical thing around congestion, inventories, etc. So, but I understand why that is. But soon we'll pass through that. I mean, my own personal feeling is that what the company has to spend its time on is taking fear away. So right now, we are using cash to reduce the net debt equity of the net debt equity ratio of the company, and that combined with future revenues should be able to, and confidence, other things that we're doing, such as doing some refinancings. We're refinancing debt that's due earlier, and hopefully fairly soon, within this, by the end of this quarter, or certainly in this quarterly report, we will be able to show the markets that, if their greatest fears were to come to pass, or there was something even worse. So let's pretend that there was a second phase of coronavirus and the world economy really went into a depression then. That Scorpio Tankers is in a good position, because I think that one of the things that we have done is in getting the biggest and the newest and the most up-to-date, modern, eco-friendly product tanker fleet there is in the world, is we've done that whilst having leverage that is probably a little bit too high when you put risk on this. So I think that if we take down the net debt to equity, that will start to close the the net debt to, the net asset value to stock price discount. Also, of course, it will allow us weapons to do something about that. Once you've got your leverage intact and your cash flow that you're generating is, for us the shareholder, well, then you can stand in the face of this, and if people are discounting the future so significantly, well, then you can just buy the stock back. That's what I did in one of my previous companies in the 2000s. We had the leverage intact. We had booked revenue. We had cash, and the stock market for a period of 20 months or so just continued to undervalue us significantly to the NAV in a rising market, in a bull market, and we ended up buying back 34% of the company. So today, that problem doesn't cause me sleepless nights, because I've learned that in the short term, it can be about price. You can have dislocations. And in the short term, a company may not be able to, or may not want to do something about that dislocation immediately. But in the long term, it will always come. Value cash flow will always trump any of the short-term price concerns or dislocation. So today, I would say, being a little bit, today the only thing that would keeps me up at night at the moment, as far as Scorpio Tankers is concerned, is something that's really, really important, is making sure, while we have this COVID-19 and we're having to work remotely in all our offices around the world, that we're able to best support our crew that are on the sea, and make sure that they stay safe, because without them staying safe, we will have issues as shareholders. So that's the thing that is most important now.
Okay. So from what you said about your allocation strategy, that right now number one priority is delever, so that your company can actually benefit from the super cycle that's coming, and then once you get to a point where you are comfortable with your leverage, you might look at buybacks. Now, is in your head, is there a particular range of levels where you would be comfortable with the amount of leverage that you have, and at that time maybe you would consider buybacks?
Yes, we have them in our heads, but we're not willing to discuss them at the moment. Okay. And part of this is because we're in a very fluid market right now, and appropriate leverage is a matrix. So first of all, what is your fleet? If your fleet is in product tankers, if your fleet is 10 years old or 11 years old, wow, that you may wish to have leverage that's only 35%, whereas a company that has 3 or 4 years old average fleet may be quite content with leverage 50% or 55%. A leverage that is longer duration. So for us, many of our leases are really long duration. They don't have to be refinanced for many years, if at all, until the vessel's older. We're going through a period now of refinancing debt that is up front for maturity. So your first thing in your matrix is, what is your assets? So a newer fleet can withstand greater leverage than a older fleet, simply because it has a greater useful life in that market. And at 15, you're really in trouble on the products. Secondly, if you're running an older fleet, you have replacement issues. And if you're going to keep your earnings up, replacement of a fleet is going to be more expensive. Whether it's older fleets are more expensive to run, older fleets are more expensive to replace. So Scorpio Tankers benefits twice now, because one, it has a really new fleet that the banks like, or 3 times. 2, its duration of its debt is quite long, and 3, it doesn't have any replacement issues. I mean, we have 120 odd ships, already the largest there. We don't have that much capex going forward compared to a lot of competitors. All those are pluses. The next part of the matrix is it's not just actual leverage, it's liquidity. So the first thing that you want to be able to cover have easily available your amortization for the forward 12 months, interest, and whatever else coverage you have. So if you've reduced your spot market break even by having time charters, for example, that are above your all-in amortization and interest costs, then you need to have less. You can afford to run a higher debt level than if you were all spot. And at the same time, if you had cash, if you already had 1 year's worth of amortization sitting on your balance sheet as either immediately available credit line or cash, then again your leverage can be less. At the moment, I know this is a long answer, but I'm trying to give a detailed answer. At the moment, things are changing very fast for the Scorpio Group. We are doing 2 things. 2 things are happening. Even though the rates have come down a little bit in the last 2-3 weeks, they are still at 9 to 10 to 11-year record highs. We're still generating a very, very, very strong cash flow. So our cash account is moving up. We are still adding to our vessels that we have secured revenue. And so it is a moving, position.
How, talking about cash flow, how does your cash flow changes on an annualized basis depending on where the rates are?
Again, it's a great question, and that this is part of it. Is that we go up or down between $55 and $60 million a year on every $1,000 a day change.
Okay.
So the record, historically, and our break even is around 17,500 all in as an average across the fleet. But that includes about $8,000 or so of amortization. So everything above 9,000, pretty much we as shareholders keep in one way or another. So that's what's so important about having the cash on hand to pay for the amortization, and once or the credit lines, and once you're very, very secure with that, and the time charter revenue you have that's above your amortization break even, that then becomes truly free cash flow for the shareholders' benefit in one way or another.
Okay. You were talking about the fleet age, and the way I understand it, because Scorpio has such a young fleet, this gives you a competitive advantage. I've been hearing this 15-year age mark for product tankers. Why is this such an important age?
What separates a product tanker from a crude oil carrier is the coatings. So each of the tanks are coated with a special paint that protects not just the steel of the tank, but more importantly, the cargo itself. And it makes sure that the cargo stays on spec or maintains its integrity. So if we take it as one of the extreme levels, we all would like to know that our jet fuel is really jet fuel, that it's not polluted in any way from the cargo before. So if, for example, you'd carried a cargoes before in the tank, and you wouldn't want those to contaminate your jet fuel. And so one of the things that happen with tanks, and of course the pipes too, and there are miles of pipes inside these ships that, rather like your bathroom, that instead of carry water, they carry the product from the tanks to the shore side or vice versa. And these internally are covered in the same coating. You can imagine it's very difficult to inspect the inside of those pipes, and super expensive if you're having to replace them, etc., etc. But over time, there's degradation in the coatings. So insurance companies, on an actuarial basis, can very often just say, look, we're just saying that at 15 years old, and there can be a problem here with maintaining integrity. So oil majors almost always say that they're not going to allow vessels over 15 years old to load or discharge clean petroleum products at their terminals and carry cargoes. And if you're not having the oil majors, and you've got insurance issues, it's hard then for people to trade that commodity, and people get higher risk. It's not to say that there are many ships, I'm sure, that could go to 17 that have very good tank coatings, and there may be some ships under 15 that don't have good tank coatings. But this is just a rule that is put in that creates an age barrier in the clean petroleum product market. At the same time as there are other cargoes, such as palm oils, that can be very lucrative cargoes, that if they're for human consumption, they must go on ships that are sometimes less than 5 years or less than 7 years old. They're just different rules. Products are not one cargo. It is very, very difficult to screw up the specification of crude oil. Very difficult. Crude oil is crude oil. It's even harder to muck up the specification of coal or iron ore. It is not difficult at all to muck up the grade or specification of what we carry on a clean petroleum tanker.
Okay, so if I am the broker that's hiring you to move a product, yeah, I understand what you're saying. Even though you might tell me, hey, my 17-year-old tanker has perfect coating, from my point of view, I don't want to take that risk.
Correct.
And that liability. So I would rather go with a younger vessel, even though I might personally trust you.
Yeah. So that means that what happens is generally product tankers, when they get to 15, get transferred to the dirty trade. And the dirty trade is obviously not a premium product trade. The value of a product tanker drops after 15 years old too, and it's one of the unique features of a product tanker is that a product tanker can carry crude oil. A crude oil tanker cannot carry products.
And there were some vessels from the product tanker that switched to crude.
Yeah, and they do that for two reasons. Firstly, the market can be stronger at a certain point. You can have a difference in arbitrage. So earlier in the year, at the end of last year, actually, the crude oil market was stronger than the product market. So some owners with perfectly good product tankers decided to take those ships and put them into crude. Other owners had product tankers that were aging or were maybe needing to have tank coatings redone because they were 7 years old or 8 years old at the Drydocking, and then they used that opportunity just to move into into crude. Now that means the following: it means that a product tanker that's trading in crude, if it's new and if it's good, could come back into products, but it would take probably up to 6 months for this to happen, because you have to go through different grades to get there. You can't just go crude, clean it up, and go products. You have to go through and almost dilute, clean, all the way through until finally you get to a point where you can trade in products. And then, even then, your premium trades in products will demand that your 3 last cargoes are clean petroleum. So you will still have a discount in doing that. So it's a very big thing. You can shake a product tanker and put it into crude in one fixture, a 1-second decision. But to bring it back, it takes a lot of money, because you have to spend money to clean the tanks. You also have to discount cargoes to get into the trade.
On average, what kind of money does it cost to clean such a thing, to bring it back?
It will depend on which way round you do it, but it's not going to be, a big ship is not going to be much less than 500 to 750,000.
Okay.
And that's without the discounting. That's just
right.
the cost of the cleaning stuff, materials.
Right. And I know that for crude tankers, when they are young, every 5 years they have to get a survey, and after 15 years, that survey has to be every 2.5 years, and the cost of that survey goes up every time it has to be done. Is there an equivalent, something like that, in the product?
Sure, it's exactly the same thing. You have to have special surveys every 5 years. You're normally going to do an intermediate dry dock within that 5 years. Special surveys every 5 years, and in products, you're okay on the first special survey. The second special survey, you're probably at 10 years, you're probably going to have to start to do something with tank coatings in some sense. And then, of course, the third special survey in products is the 15-year one, where you're not only going to have to face maybe steel replacement like a crude oil tanker would, but as I said, you're at that point where you're going to probably you'll be swapping over into dirty anyway.
When we're talking about the cost of the survey, whether it's 1.5 million, 2 or 3 or whatever, is this just the cost of the survey, or does this include the work that has to be done?
We're a bit strange in our industry. When we refer to the cost of a special survey, it is the overall cost of having the work done, the cost of putting it into dry dock, everything excluding the off-hire time.
Okay, makes sense. I didn't know that. Okay, now the next question is, I want to ask you about, okay, you, like I said before, you've been in this business for a long time, and you've been in crude, you've been in product, and you're also involved in the dry bulk. Now, why did you go into product at the time that you joined or became involved with Scorpio? What did you see happening that made you want to go to a product versus staying with crude?
The change, all my career, I'd previously been in companies that had both crude and products, and there was, really a couple of things. First of all, the dynamic in the product market, that suddenly countries like South America and Africa that you're recently seeing and are, they're starting to have a higher standard of living. They're starting to use gasoline. They're starting to use clean petroleum products more. But they don't, they don't really have yet, say, the refinery capacity to do it. The countries like the United States, much more maturing countries, were starting to get to the capacity to export products. So a trade was developing, and then going forward, you had countries like Saudi Arabia, Kuwait, or the Middle Eastern countries, India, all starting to build their own refineries, and the Middle Eastern countries saying to themselves, why should we just sell crude at the cheap end? I mean, we could build our own refineries, and we could add the value added to refining and sell products and export products. And then you have countries like Australia, for example, that used to import a lot of crude, and recently they've been closing their crude oil refineries and replacing them with clean petroleum importing areas. So they're, for environmental reasons, saying we don't want the dirty crude oil in, and we don't want to do dirty refining in our country, so we will just import the finished clean petroleum product. Either way, all of these things are in the longer term increasing the ton miles or demand for products, and increasing the ratio of product shipments versus crude. So in the longer term curve, we felt that the product market in the long term was ultimately going to be the beneficiary. The second thing is the product market has the features that it could become more of a service or more ability to be industrial, in the sense that we have a number of contracts that with customers. There is a value in having scale, because you can put contracts together, you can reduce your downtime, rather like a limousine company. If you had a great scheduling service and you ran a limousine company that had a lot of limousines and different types, you can service your customers, you can cut down the time where your limo is empty. Whereas crude oil, we felt just was increasingly becoming commoditized. There was not really that much difference, and we can see that in the VLCC market. There's not that much difference between someone who owns 7 or 8 VLCCs and someone who earns 30 or 50 in the actual dynamic or the service that they provide. There is obviously differences in the balance sheet, etc.
So from what you're saying is, it makes more sense to, or you can benefit from scale on the product side more than you can on the crude side.
Well, yes, and we think that will have as the market tightens and going forward into the future, as the owners with older tonnage disappear. So imagine if you have it, and what investors should do is not look at the average age. That was wrong of me. One should look at what are the actual ships. Do the research. If you've got a fleet with 40 ships in it, but 20 of those ships are 12, 13, 14 years old, and 20 are 3, 4, 5, the average of the fleet may be 9 years or 10. So you may simply look at it and go, oh, it's not too bad. It's just 9, 10 years old. But if you look at it in more detail, 50% of those assets you're going to have to renew them, or just exit from the product market in the next 3 years. So strategically, that company is going to have to burn a lot of capex or raise equity or whatever. So I wouldn't want to be there as an investor. Whereas in the product market, we're seeing that owners, the market is less fragmented than crude anyway. So there are less owners that own these big LR2 fleets. The LR2 fleet is a pretty consolidated market. Even though there are a lot of owners of MRs, it is still more consolidated, for example, than dry cargo markets. And many of the owners of these product tankers just won't be able to renew their fleets, because you're not going to get the financing on the old ships to do it, and they probably don't have the capital scale to raise equity capital to do it. and that's exciting going forward.
Right, right. And last time I talked to you, you actually um, said that yes, we might have a period where rates come down, but it wouldn't be that bad if they did, because uh, more of your competitors' older fleet would get scrapped, and if that were to happen, because Scorpio has a newer fleet, if we do enter the super cycle going forward, then we would be entering it with a much smaller fleet in general.
Yeah, I think it's this is it's very difficult. I mean, the as I said, we would love to see. Nothing would make us happier than to see the world get better in health and the world on the way to recovering economically. And yes, that may result in a third quarter destocking where rates aren't as strong as they are now. But we're used to in our industry having a weak third quarter. Third quarters are always, weak in the product market. But most importantly, what's happening at the moment is, you're starving capital from our competitors. You're stopping new buildings, and as you pointed out, every single day the fundamentals for the supply side are getting better. That if you are holding an older ship, a ship that's built 207, 208, 206 even, you're holding a short-dated option, because if we had 4 or 5 months of weakness for Scorpio tankers, it really wouldn't matter in the scheme of things. You're taking away, if a ship has only got 3 years left in the clean petroleum product market, so the ship's only 12 years old, you're taking away a really significant amount of its useful remaining life.
Right. The value of a vessel is dependent on the future cash flows, and
Correct.
and if you only have 2 years left, that value is not that great. But also when the rates come down, those 2 years, the value of the vessel goes down by a lot. But if you have 15 years left, then if current rates are low, there's still possibility of future rates to be medium, high, or low, and therefore the value is not that affected by where the rates are today. Am I right?
Correct.
Okay. One other thing I wanted to ask you about refineries. In your prior interview, you said that, and even right now, you said that some countries are adding refining capacity. Like, for example, Middle East, they used to sell mostly crude, and as a result, for their own product consumption, a lot of times they had to import product, export crude, and import product. And because they're building their own refineries, they are diversifying their business to also being able to export product, and that's why this was one of the reasons why you wanted to get into the product side. Now, but I've also read things such as countries like Middle East, not only are they building refineries close to their crude production, but they're also building them closer to their customers. Am I understanding it correctly?
No, they may be. They may be financing. I have no idea what the sovereign wealth funds have been doing, but the first step has definitely been for them to build their own refineries close to their own oil, and that's great. They're the newest refineries them and the Chinese are the newest refineries in the world, and there's no tort laws. They have no taxes for themselves. It's they're in a fantastic competitive position. So that's the main thing. I mean, I think it where it could be different here is for crude oil, of course. I mean, if you're thinking relating to crude oil, which is what you could have read, then it's not so good for crude oil if the Saudis build a refinery that's going to export refined products as opposed to export crude, right?
What if we're adding refineries in, let's say, Asia, China, and they have...
That's not the Saudi. It's the Chinese themselves. The Chinese themselves have been adding refined products and building again. The great things there, but the great thing for the product market here is that China just has hardly ever been a place that we would ship products to, and product market is quite ironic. It's that as you develop, the history of the product market is as you develop a region, the first thought is, oh, that would be bad for product market. But in reality, what happens is that region then trades amongst itself or trades with others, because no refinery in the world makes every day perfectly what it wants to use. So you create trade by doing that. So, for example, Europe has quite a lot of refinery, capacity, and we're trading in and out of Europe all the time. Since China has started to build its refineries, we're starting now to trade with China, whether that's feedstocks or whether that's taking surplus refined products for trading. So the opening up of refineries in China is just a plus for the tanker market altogether, whether it's crude or products.
Okay. All right. Last question. I mean, as you know, I collected some questions from the readers on Twitter, and I mean, I got so many questions, we could be talking for hours. So there's no way we could answer them all, but I tried to have it in a way so that we can touch on most of them. So the last question that I have for you is, again, going back to your experience, you've been through many cycles. Could you compare how maybe the current situation is versus what we've experienced in 2003 to 2008, and maybe even other cycles that you were involved with, and I'm just too young to even to go back that far?
Okay, so what you're seeing right now is a headline demand crunch. A headline meaning, right from the very head, world GDP resulting in less use of refined products. And the first movement to that is, oh my God, fear, right? And that's what happened in February. Oh my God, fear, rates are going to go down, stocks go down. Then the next result is quite normal. It happened in 84, happened in 1991, happened again in 2002, happened again in 2009, is the refineries in the world take longer to shut down, oil production takes longer to shut down, ships are immediately used for storage, and that creates some form of buffer against the hell that has resulted. And then the next derivative is which is what's going on right now, or 3-4 weeks ago. Then what happens is the world starts to get a little better. Headline growth starts to move up, but actually shipping doesn't go anywhere. The stocks languish, the values languish, the rates languish where they are, because every other time that has happened in my career, every other time, 1984, 1990, to 2009. I mean, there were so many. It always happened at the end of an economic boom and a boom for shipping. So, for example, in 2009, when we had lots of vessels storing or delays, like we have now, you had a world economy that didn't sort of snap back in its growth. It took a while for it to generate through. Plus, you had a new building order book that in some categories of tankers, you had as much as 50% of the entire fleet on order. Today, what's so amazing is a couple of things. Firstly, that it's a different reason that this has happened. It is for COVID-19. It's not a financial crisis that's resulted in this. We can see what is happening, and we can see, all of us can see, that every single positive movement we get, whether it's a country or in the United States, a county, a state that's allowed to do a little bit more, come out of their houses and travel and do things, immediately the use of refined petroleum products goes up, and goes up quickly. That China has already actually using more petroleum products today than it did back in January.
I think that's an interesting point, because we know that public transportation is a better way of using our resources. But now, if you're afraid to go on the subway, if you're afraid to get on the bus, if you're afraid to fly, you're gonna get in your car. And I don't think people realize that the demand for gasoline can surprise us.
There are many weird things here. If I was to go against the bear right now, which obviously I am against the bear, I would say your new building order book is hardly anything. It's aging. You've had a bunch of pent-up off-hire is going to happen because people have tried to do as little dry docking as they can while the rates have been so high and they've been worried about COVID-19. So your supply side is in great position. On your demand side, you've got clear evidence from China, Australia, New Zealand, Norway, countries that start to come under control, clear evidence that demand comes back quick and could even come back stronger because of the reason you pointed out, which is a great reason, that if you're traveling on public transport or having holidays at home, you may have greater demand. The next thing is that people get very confused on jet fuel. We don't actually carry much jet fuel around the world. I mean, there's something like 6 million barrels of jet fuel, which 3 million is used in the United States, which our international fleet doesn't carry any of the jet fuel that's carried inside the United States. So it's your gasolines and your diesels are the foundation stones for shipping demand. So this is what's different. The next thing that's different is that shipyard capacity is being constrained over the years. That finance, we've just had years of shipping finance getting more and more and more restricted. So the ability for the supply side to quickly change and add new ships is very, very difficult. It is very inelastic. So whenever you have a situation in your basic economics where supply is short-term inelastic against demand that is short-term elastic, that is very favorable to price volatility. So I think, and I hope what will happen to shareholders, because I really understand how difficult it is for shareholders right now being buffeted around by these things that don't make any sense to the fundamentals that is happening in the stock price, and really have our sympathy for that. But I think what could happen here is that, ironically, is that once the actual rates come down and people actually, realize they haven't broken their legs by jumping off the wall, that could be a point where people then really look forward and see the differences and the growing expansion at that point of the trade.
Yeah. Okay. All right, Robert. Thank you very much
Thank you.
for doing this interview. I think it's a good time to educate people on the sector. Maybe we can do it again.
I'd very much like to do it again. I mean, I think it's really, we really appreciate all the new attention. We're sorry for the performance for everybody. That's obviously not good in terms of the stock price, but we are very happy and very confident to the underlying fundamentals and performance that the company is doing at the moment, not the actual stock price. And I would love to do this. I'm happy to do this fairly regularly because, as I said, I understand there's a new audience for the first time, and happy to help in the education of the business. Look, I love this business, so happy to talk about it all day. No problem.
All right. Very, very well. Okay. Thank you very much.
Thank you. Bye-bye.